Hello friends and welcome to chapter 2 of learning AOC Advanced Option Chain from Very Basic to Advanced. In this chapter we are going to learn three pillars. In fact there are four pillars as in option chain: OI chain, volume and Greeks. We are skipping Greeks for now. We'll focus on primarily OI change and volume. These are the data that defines our market movement. Market where it will take resistance, where it will take support, where to where the market can move. We can predict using these data metrics. So let's break it down one by one. We'll start with OI and OI change. What is OI and OI change? Basically, OI and OI change is the total sum of open contracts that are available in the market. Whenever an option writer creates a fresh contract, that will increase a OI. Whenever that option writer or any option writer squares of its position, that will decrease an OI. There are minor differences between OI and OI change. OI is overall sum of open contracts in market for that strike price. Overall sum of open contracts. Whereas OI change is total sum of open contracts in a particular trading session. Suppose today market starts at 9:15. The total sum of OI in that day will be counted as OI change, and total sum from starting from the expiry till now will be counted as OI. Similarly, volume is the total sum of transactions in a particular day, in a particular trading session. This is total number of transactions. These are total number of open contracts. Let's look at an example. Suppose an option writer creates a fresh contract that will create an OI. OI will be 1 plus 1. OI change will be plus 1. And since for creating an OI, we require a buyer. If somebody is willing to sell something and there is no buyer, he cannot sell it. So, to create a contract, there must be an option buyer. And if there is an option buyer, if somebody sells an option contract to the buyer, that counts as a transaction, which is volume plus. Now, the option is with buyer. Suppose I bought an option of 100 rupees for a strike price 23,400. Now I have an option contract for pricing, cost price is 100. If that price rises to 150, I would like to book my profit. To book profit, I must find a buyer. That can be option writer, that can be a trader, anybody can be option buyer. Now I was a buyer, now I have that contract. So when I go to sell, I'm a seller now, option seller, because I had a contract. There is a minor difference between option seller and option writer. Option writer are those who create a fresh contract, and option seller are those who had already bought an option contract. Now he is willing to sell it. So I'll sell to a buyer. If that is not an option writer, this will not affect OI and OI change. This is unchanged, but transaction, thus creating a volume. Volume becomes plus 1. So now the situation is volume is 2, OI is 1, OI change is 1. Again, somebody bought it. Now he is willing to sell it. Maybe profit or book loss, whatever that can be. He must find a buyer. There can be a trader again. Even I can buy that again. Or that can be an option writer. If that buyer is an option writer, who was the writer or anybody that created the option contract for that strike price. So whenever the option writer becomes a buyer, now what will happen? Volume will increase because there is a transaction, and OI and OI chain will decrease because the fresh contract is now squared off. The person who sold it first, who created the contract, took back the contract and square off. So now the condition becomes volume is 3, OI and OI change becomes 0. Right? So this is basic calculation of OI and OI change in volume. Now let's look at concept why these are important in our trading journey, why we focus on them in option chain. So basically, option writer, when will he lose money? When will he lose money? Whenever, example, he sold 24,000 CE at 300 rupees. Now, when will he lose money? He will start losing money if the underlying, that may be Nifty stock, anything goes above 24,000 plus 300. That is 24,300. If the underlying assets price increases, appreciates to 24,300 plus, option price will increase and he'll start losing money. If he starts losing money, what can he do? He'll start selling that underlying asset to create artificial supply that will trigger the price to go down. And if the underlying price goes down, option price will go down. Now he can buy it back at a lower price and book his profit. How can he do that? For that, we have to understand who are option writers. Can I be option writer? Can I have an impact on the market? So I can be an option writer, but I will not have that much, or you can say have negligible impact on the market. Option writers have this limited reward, margin is required is high. Margin requirement is high. He have unlimited risks. He has limited risks. What was the unlimited risk here? The price can go anywhere. It can go to 30,000, 35,000. If that price goes to 25,000, he'll have to pay 700 to buy back. In that case, his loss is 400. But the price cannot go negative. At most, it can go to zero. So his profit is fixed, and that is maximum profit is 300. But his risks are unlimited. If the price goes to 30,000, he'll have like 5,600 loss per lot. So his risks are unlimited, reward is limited. He can get maximum what the option price was at the time of writing. Margin is required. Thus, there are high net individual FIIs, whatever that is, institutions that do bulk of the selling. Because if I know I have unlimited risk, my margin is required, I can only trade in the market if I am certain I can control the market. I cannot be trading on the terms of probability. So next question arises, how can he control the market? He can control the market using his cash. They have large amount of cash money plus holdings. Suppose a call option writer starts to lose money because market is rising rapidly. What will he do? He'll start selling that stock. Once he starts selling the stock, there will be artificial supply that will trigger the price to go lower, and eventually option price will reduce. Similarly, if he has created a put contract, when will he start to lose money? Whenever the price starts to fall that particular strike price. That in that case, you start using his cash to create artificial demand, starts buying that stock. Eventually, that will trigger the stock price to go higher and put option price to go lower. At the lower price, he can buy back and square up his position and actually book his profit. So, according to this theory, what we can conclude is if if there is a call writer Y and Y change C side, they will not want the price to go higher than that particular strike price. If in market something is blocking the market to go higher, what we call them is resistance. That is why wherever there is high Y and Y change on a strike price, that will act as a resistance. Similarly, for the put side, they will start losing money if the price goes below particular strike price where they have created a contract. To avoid that, they will start buying the stocks and eventually push the market higher. At some level, if the market is unable to go below that level, that is what we call support. This was easy, right? The tough thing is how to understand volume. Volume is the total number of transactions that has happened on a particular strike price. To understand volume, why it acts as a resistance for call and why acts as a support for put option, we'll look at an example. Suppose there is a shop nearby your location which has a lot of customers. What will happen? If a shop has a lot of customers, there are most probably that is chances the shopkeeper, shop owner will gain profit because the public will not have enough time to bargain. Thus, they cannot trade at a fair price. Whatever price the shopkeeper asks, you have to pay, and you will pay eventually because what you have a thought that if I don't pay that, there are other customers. They will take the product, and I might not get what I wanted. Thus, you'll pay the price whatever the shopkeeper, shop owner asks. Now let's look at how volume can act as a support and resistance in terms of call and put options. If a particular strike price has a lot of volume in call side, that will act as a resistance. In put side, if there is a lot of volume, it will act as a support. Why will that happen? Because the market do not want the mass to get profit. If suppose example 24,000 see there are a lot of traders. There are a lot of trader that has created a lot of trading activities which has created a lot of volume. They will gain money, they will gain profit if the market rises above 24,000, that is strike price. The first and only intention of a market maker is to avoid money going to a trader, retailer, the masses. What happens in nature? Few people gains and more maximum people loses. That is exactly what happens in stock market. Wherever there are a lot of volume, they are most certainly going to lose money there. In example, to summarize this in an example, what we can say is, suppose there is a shop which has a lot of customers. What happens in our natural life, our daily life? If a shop a lot of customers, shopkeeper is most likely to make money, right? Because the customers do not have enough time to bargain and they cannot trade at a fair price. You have to pay whatever the shop owner asks you. But there is an exception. Whenever there is a lot of customer in a shop, but there aren't sufficient salesmen. If there aren't sufficient salesmen, what happens is some customer will walk out without paying, some will pay half money, some will, so customer will gain some advantage only when there is insufficiency of salesperson. This is what happens in our daily life as well. So if a strike price has a lot of volume but OI and OI change isn't there, that support resistance is very likely to get breakout or breakdown. In terms of option chain, OI change is shop owner or salesman, volume is customer. If a shop has a lot of customer but there aren't sufficient of salesmen, there is high probability that the customers will gain advantage. Similarly, if a sufficient salesman and there is high volume, most probably high volume is money. So I hope you guys understood what are OI change and volume and how they act as support and resistance. In this video, I have intentionally skipped a topic, that is what is call option, what is put option, what are options, what is equity, because my understanding is if you are trading in futures and options, might have a good understanding of what is call, what is put. Even though if you want a dedicated video on that topic, please let us know in the comment section. We'll try to make that video as soon as possible. Thanks for joining. If you like our videos and want further chapters, please do like and comment on this video. We'll see you in the next video. Thank you for watching.